From New York City for our viewers worldwide, a very good morning. I'm Manus Cranny. These markets are not just counting down to the Fed, we're counting down to Tesla, which has been down for 7 days in a row, the longest losing streak since 2022. We're holding on to the green on the screen. We're going to count you down through the next hour, but the next 30 minutes takes you to the open. Coming up on the show, earnings busiest season, busiest week as we start ramping up. Futures look for direction as the markets digest the results and the Treasury yields inch higher before a flurry of bond auctions. We begin with a big issue. Earnings take center stage.
If I were to say what's a theme of earnings season so far and what we've seen for about the quarter of the market cap that's reported for the S&P, it is this. It is weak topside demand with a good defense of margins at this point. Demand is softening and weakening. Companies are doing a great job controlling the cost line and defending that margin line, but you can only do that so long.
We've had a raft of earnings from GM to Spotify. Simone Foxman is with me. Where will we land? Where will we kick off, Simone?
You know that, Manus, analysts have been pretty split about how these earnings season will work out, though they agree it is highly important. The earnings we saw out this pre-market not necessarily elucidating this narrative. We saw General Motors and General Electric both lift guidance after sales were stronger than expected, bringing to this narrative about strength among industrials at the same time as we saw PepsiCo beat on the top and bottom line, but shares are slightly lower after reporting some weakness in North America. Citi is taking the view that this is a bullish earnings season. However, they say we would view the recent pullback as a buying opportunity. Bullish positioning has unwound. The current earnings season could refocus investor attention on solid underlying fundamentals. And to that end, if you look at the EA function, the broader earnings picture on the Bloomberg, you'll see that profits have mostly surprised, especially in the consumer, tech, and industrial space. Sales more close to expectations, but when you look at sales growth for 9 out of 11 sectors, it has been positive. Of course, for the stock market, the focus is really going to be on those Magnificent Seven. We get Tesla results after the bell. Expectations there are pretty low, but much higher for Meta, Microsoft, and Alphabet, which we get later this week. Bank of America points out that there are some tough comps for these names, but the AI cycle may be a multi-year bullish push for us, and that may benefit some of these names, Meta, Alphabet, and Microsoft, Manus.
Yeah, well, certainly we're going to count down. We'll get that Tesla number out of the way later today. And then we've got to wait for NVIDIA. Once you strip out NVIDIA, those Mag 7 earnings look a little bit different. Simone, thank you very much. Simone Foxman setting the earnings stage. Also on watch today, the U.S. is set to sell a record amount of 2-year debt. Mike McKee is with me. $69 billion. Let's hope there's no indigestion.
Yeah, man, you know what they say on bond trading desks, 60 billion here, 60 billion there. Pretty soon you're talking real money. We do have 65 billion in bills going out today, but it is the coupons that are going to get the attention. This is the last week of the quarter for the coupon auctions. Next Wednesday, we get a new refunding total, and we'll see what Treasury does. They've said they're not going to increase these, but as you mentioned, we are at record levels today, the 69 billion in 2 years. Now, a lot of this is being driven by what's happening with the Fed. When you look at break-evens over the last couple of months, we have seen as Fed expectations for rate cuts go down, break-evens have gone up. The market buying into the idea that the Fed will be higher for longer. 2-year had a little issue with what was happening in the Middle East last week. But other than that, we're pretty much higher than we were about a month ago. Now, you look at the last 2-year auction, and it was basically well received. It was 66 billion, 3 billion less than the record going out today. Went for 4.595%, and bid to cover at 2.62 was pretty much on the average of the last 5 or 6 auctions. Now, you look at the when issued today, and right now we are just below 5%. It probably means we clear at the highest, the cheapest level since October 2023. 7 of the last 12 auctions have stopped through. Even the 5 tailing auctions required relatively benign concessions, with the auction never clearing more than 5 basis points higher than the when-issued yield. So at this point, we are looking at fairly good acceptance. There's the when-issued. Fairly good acceptance for the 2-year auction. We'll see how the 5s and 7s go. And then, of course, the real question is what happens next week when Treasury comes out with a new list of auction totals.
Indeed, it can be a very persuasive number for the market. Mike, thank you very much. Well, JP Morgan's Bob Michael sees opportunities in treasuries and credit.
I'm trying to hang on to all my fingers and toes and keep my discipline into month end. This feels like a real month end washout. You also still have a lot of investors wanting to take profits, or a lot of momentum investors yet to cash out. So we're really close. We're really looking at levels both in government bonds, more importantly in credit, and we feel this is a pretty good opportunity to get in.
Joining me now around the table is Mark Cabana from Bank of America. I'm tickled by that. I'm hanging on by my fingers and my toes to keep my discipline. I mean, is it as tenuous as that for you in the bond market?
So maybe not for us on the research side. We have recently been recommending that we think clients could be patient on adding duration, given recent data flow, given the fact that not all Fed speakers were on board with the cuts that some and Powell has talked about. And so as a result of that, we recommended that investors be somewhat disciplined and be patient and hang back a little bit. And we feel that that patience has now been rewarded. So we do think that it's a more appropriate opportunity now for investors to start leaning back into the market, start leaning long right now. We know that that's not a particularly popular view, given the momentum that we have seen in the market and given that rates have just sold off so sharply. But we do think it's sensible, really for 3 key reasons. Number one, we think that it's very unlikely that the Fed hikes again this cycle. Okay. Possible, but unlikely. Probably need to see inflation expectations start to unanchor. And as Mike was talking about before, we're not really seeing that yet in the break-even space. Second reason we think it's a little bit safer to lean in is because you've seen risk assets start to wobble a little bit. They clearly care and notice what the rates market has been doing. And if you see more of that sensitivity, that higher rates and let's say headwinds to risk asset development, then we think that that'll justify that lean in long view. And the third reason that we think it's safer now for investors to start leaning into fixed income a bit is that we just think positioning is cleaner. The positioning surveys that we do with our clients tell us that they're not nearly as long as they were in the summer of last year. And that long position, investors really being over their skis on duration, allowed for such a rapid rate rise. So we do think that those things allow for investors to have a little bit more confidence leaning in. And hopefully Bob and others at JP Morgan Asset Management agree with that because for those who have been hanging on, we do start to think that losses in fixed income look increasingly limited if, again, the Fed's not hiking, risk assets are noticing, and if you think positioning is cleaner.
There is a sense of exhaustion, and I understand that, but when you look at term premium, and it's interesting, we've got a lovely story. You look back at term premium back when we were kissing 5% back in the autumn time last year. Term premium was richer. How do you view the argument that there's not enough term premium to step in? I hear your judicious argument about cautious, lean in slowly. But is there enough term premium to bring real flow?
So we think that Treasuries at the back end of the curve certainly could cheapen a little bit further. We think about the best, let's say, practitioners or tradable measure of term premia as being longer-term swap spreads. So the difference between where a Treasury cash instrument is trading in relation to SOFR swap. And we think that that is a better measure of term premia than any model, let's say, that the Fed or anyone else has for term premia. And so it wouldn't surprise us to see that cheapen a little bit more. But in terms of what could cause back-end rates to continue to rise further, it's less we think about term premia. That's maybe a marginal story. But it's more about the outlook for inflation. And subsequently, the outlook for the possibility of Fed cuts and the low but increasing possibility of Fed hikes. That, we think, is the more important driver of the back end of the curve. So again, we do think that Treasuries are going to cheapen a little bit. You need auction concessions in order to bring in demand. You're going to probably see that this week. Maybe that's why rates have been selling off over the last few days. But we do think that if inflation starts to settle down, if you do start to see the economy moderate further, then we think that a lot of those concerns about term premium will be put somewhat at bay.
So the bumps in the road, if I look at 40-odd basis points of backup in 10-year government bond yields in the month of April, is that a sufficient bump in yield for the bump in the road that we presume will come through on PCE? At a headline level, 2.6%, but we're also looking at a bit of a nudge higher on the core. Is the repricing in the bond market already discounting a fourth bump?
So we think that the pricing in the bond market is reflecting an appreciation of the fact that the economy hasn't slowed as much as we thought. Inflation has not continued its trend that we saw in the second half of last year lower. And as a result of that, we think that the bond market is recognizing that monetary policy shouldn't necessarily ease, or we shouldn't see those cuts as fast as was previously anticipated. And as a result of that, look, you're seeing that risk assets, as we discussed before, are noticing. Consumer confidence as a result of that is probably also noticing. The extent to which that feeds through into spending and other activity is yet to be seen. But we certainly do think that higher rates, slightly more restrictive financial conditions should assist in helping slowing things down and get inflation on a more consistent downward trajectory, though the timing of that is very, very unclear. What we think is less likely is to see a real sharp, sustained increase in inflation from here. That and a subsequent unanchoring of inflation expectations are probably required to get the Fed hiking again. But otherwise, we think that the Fed can be patient, stay right here, and that risk assets will probably continue to notice.
Let's square it away. I mean, Larry Summers put the tail risk of a hiking, and you've been very clear, it's not at all in your base case scenario, but he's moved that up to 15 to 25%. Of a possibility. I mean, how much conversation are you actually genuinely having about war, having a war game on higher rates, on a hike?
So it's a very real discussion point amongst clients.
Okay.
I don't know that it's anyone's base case right now, but after the CPI print that we had just about 2 weeks ago, there was a discernible shift in at least our client feedback. And the questions that we get from clients. It was almost a joke to contemplate that the Fed could hike again prior to that CPI print. But after it became a very serious discussion point for clients. And they want to know, what would it take for the Fed to hike again? In terms of the probability that you put on that, I think if you look at the end of the year, the market's pricing in like less than 15% probability of no cuts from the Fed this year. So it would have to be less than that they actually hike. I would think maybe 5%, 10% on a market implied basis. So Larry Summers' 15 to 20 seems a little high in relation to the market. I'm not going to give you a specific probability right now, but I don't think that the market pricing at the moment looks necessarily wrong for the relatively low odds that it would imply on another Fed hike. And again, for fixed income and for fixed income asset managers, this is so important, right? Will the Fed hike again? Because if they don't hike again, and if you've got confidence in that, then really leaning into fixed income limits your downside. Think about it this way. So the 2-year is going to maybe price with a 5% handle at the auction today. If the Fed doesn't do anything for 2 years, where will the 2-year note actually realize? Probably around 5.35 to 5.4%. So yes, you can see a little bit of further cheapening, but you've got limited downside. And what's the risk that something unexpected happens that could see the economy slow? That's what we think the market is still pricing a fairly decent probability of in the market today.
Well, coupon clipping at 5.4%, if that's your worst case scenario, is not exactly a tragedy, is it?
That's right. Nor is coupon clipping at 5%, right? So why not take the shot with the risk that maybe the economy does slow unexpectedly, or maybe inflation does fall, and maybe the Fed is able to deliver a more aggressive pace of cuts.
Mark, we get the message, maybe a concession today and over the week in this auction, but certainly no indigestion. Good to see you this morning.
Thanks so much for having me.
Mark Cabana joining me with his outlook on the bond market. We're ahead of the opening bell. Abigail Doolittle is side by side with me on the movers.
Well, Manus, we have a big decliner on the morning, despite the fact that we have futures higher. We have the shares of JetBlue absolutely plunging down more than 15%, heading to what I believe is their worst day in at least more than a year. They warned of less revenue and higher costs in the year ahead, and apparently excess flying capacity in Latin America really a problem. Analysts saying that their results just not on par with the competitors. As to what's helping the stock futures go higher today, GM shares are higher in a big beat, and they also boosted guidance as truck sales overshadow weakness in China. GM, more on this on the open. Actually, UPS, down about 0.6 of 1%. Not the strength that I was talking about for GM. Lockheed Martin, on the other hand, up 1.2%. A big beat and raise for the defense contractor. And then Spotify, Manus, take a look at this stock, up 12%, up 45% into today, year to date. They beat adjusted earnings by 66%, putting up nearly $1 in adjusted earnings. Subscribers to paid Spotify tiers grew 14% year over year. Again, that stock soaring and set on the year to open up about 60% year to date.
Abby, thank you very much. Coming up in the show, we'll dig deeper into the GM. It cruises along. Analysts predict more pain for Tesla.
Tesla can't seem to get out of their own way, right? Their stock doesn't meet our selection criteria, lets them take them out of the Mag 7 altogether.
Auto sector in focus. That's next on Bloomberg.
Tesla can't seem to get out of their own way, right? They've cut jobs, they've cut prices, they've abandoned the production of their lower cost vehicle. And now we've learned, at least last quarter, that global deliveries fell for the first time in 4 years. Their stock doesn't meet our selection criteria, lets them take them out of the Mag 7 altogether.
So in case you hadn't got it, it is all about auto earnings this week in focus. General Motors boosting their outlook as strengthening U.S. truck sales overshadow the losses in China. Now, the attention pivots to Tesla, the second worst performer on the S&P 500 this year, gearing up for their earnings after the closing bell. Craig Trudell is with me. My guest this morning, Craig, said kick Tesla out of the Mag 7. What is it going to come down to on this earnings print today? Craig?
Yeah, I think to your guest's point, the concern about the $25,000 car going out of the window is a lot of what's going on here. But we also shouldn't overlook the fundamentals. This is a company that the revenue, the earnings, the gross margin, the free cash flow, everything's trending in the wrong direction. And there's a lot of concern about, can this company sort of fix its existing business as it's making this, massive bet, high-risk bet on robo-taxis that, we mentioned at General Motors, they've had quite a bit of challenges with doing precisely what Tesla's trying to do with their cruise business. And it's really remarkable to see the trend in the last few months when GM, their cruise business, was grounded. They focused on returning cash to shareholders, put off some EV investment, and we've seen their shares outperform Tesla to a significant degree.
Yep, and certainly I think he or she who wins the SUV market, whether it's electric or otherwise, sort of wins the war of profit for now. Craig, thank you very much. Craig Trudell there, obviously GM guiding higher. They see $9 to $10 in earnings. Originally that was $8.50 to $9.50. My next guest writes this. Tesla's death spiral is increasing in velocity as Musk shops around on a monster fundraise for yet another company of his, that is XAI. Let's have that conversation with Clio Capital's Sarah Kunst. She joins me now. Sarah, I mean, if I said Tesla was in a death spiral, I'd probably get into trouble. But you are in another part of the market, so you have latitude. Is Tesla really in a death spiral?
It certainly looks that way. We are seeing that stock that has gone from strength to strength, largely just on the basis of Elon, right? They didn't invent cars. They didn't invent electric cars. And now there is a lot of competition in the electric car market. It's been waning for a while. And, I think that a lot of us are overlooking some of the risk that are going on inside of Tesla with this potential move to Texas, that seems to be a way for Elon to bring that monster pay package back to the table. But the reality is that it was struck down in Delaware for a reason. And there's real sort of issues, most likely, if he pursues it again in Texas. And so I think that there are a lot of different problems happening around Tesla. Certainly the macro, EVs are not doing well in general, have just created an environment where it feels like he's focused a lot on his other companies, obviously X and XAI. And so I just don't know if the Musk magic is still there.
Peak Elon. I mean, it's almost like, Thatcherism, Trumponomics, and then there's Muskism. It's a question of whether you believe in that. Would you be more sated if we had an AI day, the AI story, autonomous driving, Optimus, etc.? Would you be more inspired if you understood what the AI component was really within Tesla and the monetization prospect of that?
Here's the problem, right? I do understand it. And the reality is that we can look at companies like Alphabet and what they're doing, with their self-driving cars, which that's generally what you're talking about when you're talking about AI in cars, the ability for the car to operate more autonomously. Ford is doing a lot of interesting things on that front. Cruise, certainly at GM. And so we can see that, right? When you're in San Francisco, the self-driving cars are everywhere. So we know what that looks like. And the reality is it doesn't really play to Tesla's strengths. And candidly, nobody's making a lot of money right now from AI and self-driving cars.
No, it is very difficult. Let's just shift the conversation along because Congress has now voted on TikTok, and there's a whole lot of discussion around the demise of TikTok. What will TikTok be if it's sold off from ByteDance? Where will the algo go? But I want to understand a broader construct, which is the others who benefit as we have TikTok angst. And if I look at Meta, I mean, it's just way, way ahead on Reels. 200 billion views on Reels, and Alphabet has YouTube. Is TikTok's prevarication about TikTok the opportunity, the ultimate opportunity for Meta and Alphabet?
It certainly is an opportunity for Meta, probably bigger for Meta than Alphabet, just because, while YouTube Shorts has certainly done decently well and people spend a crazy amount of time watching YouTube, it doesn't monetize YouTube as much. Alphabet doesn't. But when you look at Meta, yes, I think that when creators get worried that their livelihoods are going away, when brands who depend on TikTok to get their revenue see that, hey, it might go away, they have to be pragmatic and say, where else can I go? And the reality right now is that that's primarily going to be Instagram and Reels, their short form video product. And so I think that we will continue to see a flight to that relative safety. I think we'll also see companies, new startups, try to come up with entirely new companies that sort of ride the wave of, hey, what are people going to do with all their free time if TikTok's For You page is gone in the US? But thus far, I'm not seeing a lot of investors really lean into that thesis, in part because it didn't work really the last time around when TikTok was set to be banned.
Sarah, thank you so much. Let's see what those numbers are from Tesla a little bit later on, whether we can convert you in any way. Coming up, your morning calls. Jen Trust's Mimi Duff joins me, makes the case for bonds over stocks. That conversation next. Some morning calls for you. Truist upgrading Penn Entertainment to a buy, saying the markets are underestimating the prospects for ESPN. Next, you got Wolf Research downgrading Warner Brothers to underperform, pointing to profitability headwinds and disappointing studio results. And finally, JP Morgan downgrades 5 below to neutral. Caution on the consumer. Markets are putting in a bit of a heroic performance. Go on the Jeep. In the end of the day, the SUV is the bulwark for Ford, for GM. That's got a lovely rising tide, setting the tone on the reporting season. Can the Tesla numbers, can the Mag 7 actually deliver? So we're a bit up on stocks. We've got a Monty of an auction coming along, $69 billion of 2-year government bond yields are going to hit the tape. The dollar is flat. The euro is up ever so slightly. Private sector activity advancing to the highest level in almost a year. And so the euro is a little bit higher. There you go. GM up 5.5% before the bell. We just rolled it over into the opening session. Yields cheaping up by 2 basis points. We've just had Bank of America here. You may have to see a little bit of a cheapening in the concession in the auctions this week to get the paper away, but no material risk. Lean in gently to duration. Oil down by 0.5% at the moment, 81.55. The war risk premium has dissipated ever so slightly. I mentioned the SUVs were the alpha in the reporting story for the car makers. GM is there expecting better profit this year on those truck sales in the US, led the automaker to raise its 2024 guidance by $500 million. Abigail Doolittle, have you got a truck, Abby?
I do not have a truck, although I do have an SUV, so I guess I'm in that larger car category. But investors really liking this quarter and the outlook, Manus. The stock up right now about 5%, the best day going back to January. They put up a very nice beat across the board, adjusted earnings of $2.62, 24% better than expected. Revenues of $43 billion, 2% better than expected in a difficult environment. And you were mentioning that they did increase guidance from a net income standpoint by $300 million for the year to between $10.1 billion and $11.5 billion. So some positive cheer there. CFO Paul Jacobson giving some good color, saying the U.S. consumer, despite rising rates, remains very resilient. They also mentioned, he also mentioned that pricing was about flat in the quarter. So it seems as though there's some pricing resilience there. It could erode as the year goes on. But again, the net income, they seem to be managing any sort of issue there that could happen. And all of this U.S. strength, well, it offset some of the China weakness, given the competition in China from some of the Chinese car makers. Into today, Manus, the stock up 20% year to date. A banner year so far for GM.
Yeah, well, you just put that relative to the no man's land of Tesla down 40%, and you begin to understand the gap. Abby, thank you very much. Let's turn to the shipping industry. UPS reporting higher profit as the result of headcount management and restructuring of its delivery routes. Katie Greifeld is with me. So some subliminal terminology there for job cuts.
Yeah, perhaps. But you take a look at what shares are doing this morning. They're up slightly. So let's get into some of the numbers here. Adjusted first quarter earnings were $1.43 per share. That is above estimates. Analysts had been looking for $1.30 a share, so it beat there. UPS also maintained its guidance for the full year. Of course, UPS, it's been trying to expand its sales and profit. Demand has been a little bit softer for package delivery coming out of the pandemic. It said last month that it expects consolidated revenue to climb as high as $114 billion in 2026. That is up 25% from last year. Meanwhile, though, you take a look at what the sell side is saying. It's not too warm, I would say. You have Morgan Stanley saying that while this appears to be a healthy beat and may spark a modest relief rally, we doubt that the numbers will come up or the market would consider this to be a turnaround in the recent negative momentum in the numbers. Meanwhile, you take a look at Evercore ISI expressing some skepticism about whether they're going to be able to meet their forecast. They say that the results, they do show upside to recently lowered earnings estimates, but the stock's path over the near term will depend on the path to meeting full year guidance. Again, shares up a little bit today, but still down for the year, Manus.
Okay, Katie, thank you very much. Katie Greifeld there on UPS. To the airlines, JetBlue's forecast for the second quarter and annual revenue, they were worse than anticipated, citing excess capacity in the Latin American region. Isabel.
Hey, Manus, investors are really not liking this because shares tumbled as much as 20%. That's the biggest drop since March 2020. And shares have since pared some of those losses, but still down by 15%. If this continues, JetBlue is on track to shed some $400 million in its market cap. So the airline lowered its 2024 revenue. And this is a setback because JetBlue is trying to return to profitability. So JetBlue reported revenue that will fall as much as 10% year over year. And that's compared to the 3.8% that analysts have average estimated. So a Citi analyst said that the guidance for the quarter and the full year were not nearly as strong compared to its peers. And this could cause JetBlue to, quote, relinquish some of its recent share price gains. And indeed, Manus, JetBlue's rivals like Delta and United have forecasted profits, strong revenue, and record demand this quarter. But just like its rivals, JetBlue also had the same problem in Latin America because they put too many flights there, especially in leisure destinations. But for now, it's really been a tricky year for JetBlue. Recall that earlier in the year, they had to call off their merger agreement with Spirit after a judge blocked the $3.8 billion deal on antitrust grounds. For now, shares are still slumping by around 15%, Manus.
Okay, Isabel, thank you very much. Isabel Lee on the JetBlue earnings. Now to Apple and the iPhone. Sales in China fell 19%. That is the worst performance since 2020. The data comes from an independent research firm. Ed Ludlow is with me. I mean, this is a confirmatory note, really, isn't it, Ed? We've had a couple of assessments of the demise of demand in China. So what is today's new news?
Well, there are some idiosyncratic factors because the first 3 months of the year include the Chinese Lunar New Year. And that has historically been a time of strong sales for Apple. The Counterpoint research data does show a drop of 19% year on year in the period. and idiosyncratic in the sense that unusually Apple actually offered quite significant discounting and incentive to try and bring those consumers in, and that didn't work. The bigger picture is that the Counterpoint data also gives us an interesting picture of market share in China. Apple has fallen to third in the smartphone market, but it's interesting to note the gains that Huawei is making in the higher end of that market. They basically now have very similar market share of around 15.5% each. So that is the other part of the story where Apple is facing increased competition. The moment you started reading the intro, I don't know if that was it, Manus, but the stock actually paired its early decline. It's basically flat down a percentage point, but a tenth of a percentage point. But it is a few tenths of a percent away from its lowest level in a year. We're not that far off from earnings. And again, stressing that this is third-party data, but it's third-party data kind of in line with what IDC told us a couple of weeks ago, which was overall iPhone shipments in the first quarter were down 10% globally, with particular pain points in China. There's a growing thesis on the street and presented by Bloomberg's Mark Gurman that the high end of the smartphone market's getting tough. Do we start to see a really, really cheap version of the iPhone to go after volume in new markets like India and elsewhere? That will be a question for earnings, down 0.2%.
The democratization of the iPhone, it comes at a cost of price, doesn't it, going down the scale? Thank you very much, Ed Ludlow, on the Apple story. My next guest weighs in on the future of the rates market, saying this: our primary concern is that large swathes of the economy are not workable at these restrictive rates for long period of time. And that leads us to have higher than expected recession risks penciled in relative to the market. Mimi Duff is going contrarian, managing director of Gen Trust. It's not full contrarian. I think what you are doing is raising the flag that the whole market is so bulled up that there's a risk. In your view, there is a risk of a recession. My question would be to you, is that a building contrarian narrative, and how bad a slowdown can it be?
Yeah, I mean, look, we see a clear possibility for just more of the same, which is pretty strong growth. We'll see that data on GDP data this week. Inflation is above trend. There's a lot of optimism priced into equity markets. We're going to get 40% of the S&P reporting this week. We'll get a lot more information on that front. We'll see the PCE data this week on the inflation side. But, you know, if we get more of the same, it's hard to argue that the Fed should be an easing stance. And the market has repriced to greatly diminish those odds of easing this year. So on the other side, if we stay at 5.5% base rates for an extended period of time, we do think, like commercial real estate, for instance, you've got $1.5 trillion that needs to be refinanced in the next between 24 and 25. Residential, current homeowners are in fine position right now, but it's decreasing mobility, for instance, with mortgage rates at 7 or 8%. So those are just some of the kind of things that we see risks on the horizon.
So the refunding, I mean, the narrative was this, is that the refunding was something that would take place in 2025. The mortgage market, the retail person like you and I has already remortgaged, and they have a pretty good rate. So you're putting this recession risk into 2025 if we do not have insurance cuts from the Fed. Is that the correct way to think about the warning?
Yeah, I mean, the longer we stay at these restrictive rates, most folks would not argue that 5.5% base rate is pretty restrictive. The longer we stay here, it is going to weigh on these segments of the economy. For now, consumers have been fine, but their savings have been eroded greatly. So eventually, I think it's going to come to the forefront.
So tell me then, are you tempted? We've got a little bit of 2s, 5s, and 7s this week. Everybody's telling me the auctions may cheapen up a little bit. You shifted to an overweight, but you remain short on duration. Just give me the construct of where you want to be on the curve.
Yeah, so we like that 2s, 5s, 7s. The duration of the index is something like 6.8, and our durations are shorter than that, with 2 years up around close to 5%. And you know, we think that these are levels that the duration this week will be digested, and closer to 4.8% in 10s. We would look to square up in terms of being neutral duration as well.
And the equity portion, I mean, as you say, we'll know an awful lot more. It's like the sword of Damocles, isn't it? Tesla tonight, what happens with a little bit of Microsoft, etc. You'll get a smack and a boon, won't you, this week in terms of some of the big names. But with equity at the moment, the left tail risk is rising. It's not equity markets are not collapsing, but they are nervous, aren't they?
Yeah, I mean, look, we're long-term, long-only, and so our portfolios have healthy allocations to equities, but we have recently shifted to underweight given the construct that the full picture that we're seeing.
And in terms of the actual defensive nature, if the left tail risk is rising, where do you see the biggest defense? Do bonds suddenly take on that hallmark again of a resort, of a haven? We saw it last week very clearly when geopolitical issues came to the fore. But when you look at the fixed income portfolio, does that become slightly more haven-like?
Yeah, that's our hope, is that if equities do falter, the fixed income will perform. And yields are high enough right now that you should be able to earn that yield over time as well. It's not costing you a great deal to have healthy allocations in that area too.
Okay, Mimi, thank you so much. Let's see what the big beasts of tech give us over the next 24 hours, because it will be certainly a decisive note for sentiment on big tech. Speaking of which, coming up, TikTok, the bill is heading to the Senate.
The House put everything together to also try to force the Senate to vote on some of these things. As we all know, the Senate has been holding up a vote on the TikTok ban. The House deliberately put it into this package to make sure that the Senate would vote on it.
Lawmakers prepare for procedural votes. That conversation ahead on Bloomberg.
The House put everything together to also try to force the Senate to vote on some of these things. As we all know, the Senate has been holding up a vote on the TikTok ban. The House deliberately put it into this package to make sure that the Senate would vote on it. And that's why we expect everything to pass this week in the next day or two.
The House's strategy for the Senate. And the Senate will vote on the foreign aid package set to take place today. And that includes aid for Ukraine, for Israel and Taiwan, and the bill that would force ByteDance to divest from TikTok. President Biden tells Ukraine's Zelensky that aid will flow quickly if the Senate approves the package. Anne-Marie Hordern is with me now. So, Anne-Marie, this is a pivotal day on the voting. Are we in any doubt on any aspect of this quad?
There's really no doubt that this larger package that was voted in smaller packages in the House is going to go through. The only question is a matter of when. How long do they draw out debate on this bill? So potentially it can happen today, or maybe this will bleed a little bit more into the weekend. Remember, the Senate is supposed to be on recess, and they're coming back, senators, coming back to Washington today to vote on this bill. You saw President Biden speak to Zelensky yesterday, and they have been preparing for when this actually got voted on to make sure that weaponry goes out. Of course, everyone is excited to hear about potentially the debate on TikTok. Ron Paul over the weekend was talking about how this is a ham-fisted assault. His words when it comes to TikTok. But let's see, even if this goes through, it means a year to divest or therefore to be a ban. But this can get drawn out, of course, in the courts and the legal proceedings that TikTok is preparing for.
You need that TikTok going into this election. I'm big on TikTok. Now, talk to me about handbag wars. The FTC has sued. They're going to stop the group Tapestry from acquiring the rival Capri. The ticket size, $8.5 billion. I mean, I'm being a little bit disingenuous, handbag wars. But why? Why has the Biden administration decided that it's in its interest to step into handbag fashion?
Well, there's one thing that we hear from the FTC is this is to make sure that there's competition when it comes to workers and wages. And this would just be a larger group of 33,000 people. Potentially that preservation, the labor market is something that we have seen also in the past, Lina Khan lean on. But we should note that this Biden administration, we've seen a record amount of antitrust enforcement under Lina Khan and Jonathan Cantor of the DOJ. So this isn't actually an administration or FTC that has been friendly to deals. And this is just the latest in a string of deals that have been sued or pretty much got blown up by this FTC. And what is so precarious to me is the fact that this deal between Tapestry and Capri had the go-ahead from regulators in Europe and Japan, but it's being stopped short in Washington.
Yeah, and there's the other side of the trade, which is it creates a much bigger luxury beast here in the United States of America, perhaps not at the size of LVMH, but one could argue is that it creates, a significant competitive galvanized force. Anne-Marie, thank you very much. Anne-Marie Hordern on the politics of Capitol Hill and M&A. Some breaking news coming across the Bloomberg terminal for you. Let's get back to Mike McKee. These are on the PMIs with some in Europe. How does it look in the United States of America?
Not so good, and that is actually causing a big market reaction right now. The S&P Global PMIs for manufacturing come in at 49.9 in the U.S., down from 51.9. That is the lowest since December. Services PMI at 50.9 comes down from 51.7, the lowest since November. So we are seeing some weakness in the United States that we don't normally see in these indexes, at least compared to Europe. Europe earlier today was showing some weakness in manufacturing, but services ticked up. So this is having an impact in the bond market. As you can see, we've got the two-year note gave up 6 basis points immediately and now has come back just a little bit. But the comparative interest rates in the two areas are going to make a difference to, it appears, to bond traders. And it'll be interesting going into the two-year this afternoon, the auction, to see if this carries over.
Well, there is the immediate bond reaction, which is yields down. 4.95 is where we are on the 2 years. People are talking about a cheapening up of the concession, $69 billion worth of two-year auction paper coming to the market. As you say, this is a little bit of a shock on the back of the April 8 PMIs. Mike, thank you very much. We'll get some sector price action now. It's a big day. Lots of sectors in focus, from autos through to travel. Abby, what have we got?
Well, not surprisingly, with the S&P 500 up about 0.6%, getting a boost off of those weak PMIs, up for a second day in a row. The best 2 days, Manus, surprisingly, in 2 months, up about 1.5%. So the selling that we've seen recently, not out of nowhere. But take a look at all the sectors that are higher. Communication services, the best, up 1.1%, being helped out by the likes of Meta, Alphabet, Verizon, Netflix, Take-Two. So lots of strength there. Industrials, utilities, healthcare also higher. To the downside, materials down 1%, and then energy down about 0.4%. One area that we have not looked at in quite some time, that is the NASDAQ Golden Dragon Index, basically China tech shares. This index over the last 2 days, it is up 3.7%. So some really impressive gains there. And helping out today, the likes of Alibaba, JD.com. And for this index, those are the best 2 days. I'm just waiting for the Bloomberg terminal to spit the number out since March 13th. So we have some U.S. big cap strength, and we also have some China big cap strength, Manus.
Abby, thank you very much. Coming up with market moving events that we're going to set your trading diary by, and bonds will feature heavily. We've talked a lot about the divergence in terms of macro policy between Europe and the United States of America, but this is the differential. The bond market is showing you when you get weaker PMIs in the United States relative to Europe. There's no irony lost in that. We're looking at the PMIs, U.S. business activity, expanding at the slowest pace this year. Now, this looks a little bit more dramatic. It's only a couple of bips lower, but you've got $69 billion worth of two-year paper coming to the market later on in terms of the auction. So this is just one of those moments where there's a tiny fissure in the economic story. I'm going to set your trading diary for you. I mentioned the bond auction, $69 billion worth of two-year paper will come. That will feature. The auctions will be 11:30 p.m. and 1 p.m. Of course, it's about Tesla and their earnings. We then flick over to IBM and Meta out with their results tomorrow, but not before we've talked Tesla into the ground. Thursday, Alphabet, Microsoft earnings, plus US GDP, and another round of jobless claims. It's going to be interesting to see what those jobless claims once we've had those PMIs just incrementally lower. The employment component, by the way, sliding to 3.2 from 48. Flick it over to Friday, and we get University of Michigan sentiment survey and the PCE deflator. That will wrap up the sentiment for the week. It could also be the death knell in rate cuts for 2024, or certainly a repricing of those. That was Countdown to the Open with me, Manus Cranny, from New York on Bloomberg.